Here's something strange. And once you see it, you can't unsee it. You put your money in a savings account, and the bank pays you almost nothing for it. A fraction of a percent. Basically, a rounding error. And yet that same money is clearly worth a fortune to them, because the second it lands in your account, they turn around and lend it to someone else for a car, a house, a business, a credit card balance. At 8%, 15%, sometimes 20%. So think about what's actually happening. You are lending the bank money. You are the lender, and you agreed to charge them almost zero. Nobody would ever do that on purpose. But almost everyone does it every single day and calls it saving. Your savings account isn't a place where your money grows. It's the cheapest loan the bank will ever get in its life, and you're the one who forgot to charge interest. Let's clear up what a bank even is, because the picture in your head is probably wrong. You imagine a big vault where your money sits safely, waiting for you. That's not it at all. The moment you deposit money, the bank does not put it in a drawer with your name on it. It lends most of it out. A bank is not a safe. A bank is a machine that borrows money cheaply from one group of people and lends it expensively to another group, and lives on the gap in between. The people it borrows cheaply from, that's you. The depositor, the saver. You are the raw material, and the entire art of running a bank is getting that raw material as cheaply as possible. Ideally, for nearly free. This gap has a name, and it is the single most important number in banking. It's called the spread, or the net interest margin. Here's the whole business in one sentence. Pay depositors as little as possible, lend to borrowers as much as possible, and keep the difference. Say the bank pays you 0.5% on your savings and lends that same money out at 7%. That 6.5% gap, multiplied across billions in deposits, is the engine of the entire institution. It pays for the branches, the apps, the salaries, the profit. Let's make it concrete. Imagine you keep $10,000 in savings. At 0.5%, the bank hands you $50 for the year. 50. Meanwhile, that same $10,000 lent out as part of someone's car loan or mortgage might earn the bank $700. You got 50. They kept the rest. And before anyone says, "My country's rates are higher," they might be. In some places, savings pay more and loans cost more, in others less. The exact numbers move with wherever you live. But the gap, the spread between what they pay you and what they charge everyone else, that part is the same everywhere on Earth. That's the point. It's not about one number. It's about the distance between two of them. And notice where it comes from. It doesn't come from some clever investment or some genius trader. It comes purely from the difference between what your money is worth and what they pay you for it. The wider they can keep that gap, the more they make. Which means every bank on Earth has a permanent, built-in reason to pay you as little as they can possibly get away with, and to make leaving feel like more trouble than it's worth. So why do we let them? Why does anyone accept 0.5% when the bank is clearly making far more? 3 reasons, and they're all about you, not the money. First, convenience. Your salary lands there, your bills come out of there, moving it feels like a hassle. Second, safety. In most countries, deposits are protected by the government up to a limit, so it feels risk-free, and risk-free makes people stop asking questions. And third, the big one, inertia. Most people open one account when they're young and never move it again. The bank knows this. They are not pricing your account based on what your money is worth. They are pricing it based on the near certainty that you will never leave. You are not a customer they have to win. You are a customer they already own. Here's where it gets sharper. Central banks, the institutions that set the base interest rate in every country, regularly set that rate well above what your bank pays you. And in many countries, the bank doesn't even have to lend your money to profit from it. It can simply park it with the central bank overnight, risk-free, and earn something close to that base rate on your money, and then turn around and pay you a fraction of it. The gap between what they earn just holding your deposit and what they hand back to you is pure, effortless profit. No lending, no risk, no work. They are not passing the rate on to you because they don't have to. And here's the tell. When the central bank raises rates, the interest banks charge on your loans jumps almost overnight. But the interest they pay on your savings? That crawls up slowly, reluctantly, if at all. Rates go up fast for what you owe and slow for what you're owed. That asymmetry isn't a coincidence. It's the business. And they quietly hope you never check what the base rate actually is, because the moment you do, 0.5% stops looking like a little and starts looking like what it really is. A choice they made, at your expense. Now stack one more thing on top, and this is the quiet one. Inflation. Prices rise over time. That's true in every economy on the planet. If prices go up 3% this year and your savings earned you 0.5%, you didn't make money. You lost 2.5% of what your money can actually buy. The number in your account went up slightly, so it feels like growth. But growth is an illusion if the price of everything grew faster. This is the trap that makes a savings account feel safe while it quietly shrinks you. Your money isn't disappearing on the screen. It's disappearing at the store. And the bank is perfectly happy for you to keep confusing the number went up with I'm better off. Quick pause. Because what comes next is the part that actually puts money back in your pocket. If you're getting something out of pulling these everyday systems apart, seeing exactly where your money quietly leaks and how to stop it, hit subscribe. That's the whole idea here on Priced. We take the prices and the products you never think to question, and we show you the machine underneath, the part that only makes sense once someone points at it. Subscribe and stick around because now we get to the good bit. What to actually do about all this. So here's the first move, and it costs you nothing but 10 minutes. Understand that a regular savings account at a big bank is, almost by design, the worst place to keep money you're not spending this week. The default option is the bad one. That's not an accident, that's the product. So the fix is simply to stop accepting the default. In most countries, there are now high-yield savings accounts, often online-only banks with no branches to pay for, that pay many times what the big bank pays you for the exact same safety and the exact same government deposit protection. One thing to check, and it matters. Make sure it's an actual bank account covered by your country's deposit guarantee. Some flashy, high-return apps aren't banks, and that protection doesn't apply. But for a real, covered account, it's the same risk, the same money, several times the return. The only difference is that you had to go look. And if you want to go one step further, there's a whole category of boring, low-risk options that most people never touch because they sound complicated and they're not. Government bonds, money market funds, short-term treasury-style products. These are, in many countries, about as safe as it gets, often backed by the government itself. And they frequently pay you close to that central bank base rate, the rate the bank was quietly earning on your money and not sharing. Think about that for a second. There is often a way to earn, safely, roughly, what the bank earns on your deposit, instead of the scraps they pass back to you. You don't need to become an investor. You don't need to watch charts or take a single big risk. You just need to know that in the bank and doing nothing are not your only two options, and that the gap between a lazy savings account and a boring safe one can quietly be the difference between beating inflation and slowly losing to it, year after year, without ever noticing. There's a third move, and it's almost too simple. Make them compete for you. The entire reason banks can pay you nothing is that they're betting you'll never move. So threaten to move. When a new account somewhere else pays more, you don't even always have to switch. Sometimes just being willing to is enough. Split your money. Keep the account you use for daily life, but move your actual savings, the pile that just sits there, to wherever it earns the most. The moment you treat your savings as something with a price, something you can shop around, exactly like anything else, the bank's whole quiet advantage falls apart. Loyalty is the thing they're charging you for. Stop paying it. Step back and look at the shape of it. The system isn't a scam. Everything the bank does is legal, disclosed, and printed somewhere in the fine print. It's built on something softer than a scam and far more reliable: your attention. It's engineered around the safe bet that you're busy, that money is stressful, that in a savings account sounds responsible, and that you will almost never sit down and compare. Every part of it, the near zero rate, the comforting word savings, the friction of moving, is designed to keep you exactly where you are. It's not one big trick. It's a dozen small nudges toward doing nothing, because doing nothing is the single most profitable thing you can do for them. So here's the reframe that changes everything. Stop thinking of your savings account as a safe box, and start thinking of it as a loan you are making to a very large, very profitable company, because that is exactly what it is. And once you see it that way, the only sane question is the one every lender asks. What interest am I getting for this? If the answer is almost nothing, then you are giving an interest-free loan to an institution that would never ever return the favor. You wouldn't lend your money to a stranger for free. You just did it to a bank, and they thanked you by calling it a service. So here's everything, compressed into things you can do this week. Look up what your bank actually pays you, then look up the central bank's base rate and feel the gap. Move your real savings to a high-yield account with the same protection. Learn that boring, safe options exist that pay close to the base rate, and treat your money like it has a price because it does. You're just letting someone else set it. You don't need to be an expert or take a single risk. You just need to stop giving away, for free, the one thing the whole system is quietly counting on you to give away. So next time you see that comforting number in your savings, ask what it's really earning. You're not saving, you're lending for free. And if a bank can profit this quietly, wait until you see the room built to do it on purpose. The dealer's finance office. Watch it next.